Hey guys, Brett Burns here, Director's Mortgage. Welcome to today's live. Thank you as always for joining. Hey, today wanted to focus on discount points or points, kind of what they are, when they make sense to use, when they don't, kind of some particulars around that. So I'm sure many of you have heard this before. So the terms can be called points, most commonly, discount points, rate buy down. Those are all kind of the same mindset for us. So really, what is it? So I think one of the biggest things to start with here is, guys, when someone calls and asks, what is the rate today? Unfortunately, that's a tough question. Here's the reason why. There's tons of rates today. For example, I have rates I could offer you today up close to 8% and rates down close to 5%. Within that, each rate has a corresponding cost or credit. That's where kind of points come in. So, I like that first point to know is, guys, there is a ton of different rate options out there. And the way I oftentimes tell clients about it, it's like a stock. There's lots of different stocks to buy. Now, all those stocks can be different prices. That works very similar with rates. So an individual rate could be a mortgage-backed security at 7%, 6.5%, 6, 5, and so on. So there's a ton of different versions. Now, you will hear, of course, what is the average rate today? What are most clients settling it on? And that's what I think clients think about when they hear what is the rate today, or they ask that question. But I let clients know, guys, ultimately, you have the choice on a ton of different rate options. It just comes down to what cost do you want to pay. Again, that's often referred to as the points. So let's dive through some of the details here for us. So points are going to be when we pay a fee at closing. So it's an upfront fee that is used to bring the rate lower. So if we have a 7% rate versus a 6.5, the 6.5 rate will have more expense or points to bring that rate down. And vice versa if we go the opposite way, or again, further and further and further down. So with this for us, one of the key pieces then clients ask is, okay, if I have multiple options, isn't a lower rate always better? Well, the answer is going to be no. It's going to be very situational for you. It's going to be based on looking at what is the cost of points versus the savings. Now, driving your payment down is absolutely important. It's a great thing, but I will caution folks. Sometimes I see a lot of people get very, very focused on the monthly payment or cash flow. And I appreciate that's kind of how we live our lives. Hey, I got to pay this bill this month. But we also want to know, well, how much in points am I paying? That may be cash up front I pay, or on a refinance that may be built into my loan. So oftentimes clients might not realize how much they are paying at some point down the road by building points into their loan versus a little bit different monthly payment. So something you want to clue in on. So, let's go through a couple things on it. Now, when we call points, where does it get that name? Well, points are often said that way as a percentage point of the loan. So let's look at some basic numbers here for us. So if we have a $500,000 mortgage for us, and we said, okay, hey, I want to pay 1 point. Well, that's going to be 1% or 5,000. That would be the points cost. Now, one confusion is oftentimes clients go, I want to pay 1 point, meaning they think their interest rate drops a full 1%. Not quite how it works for us. So it's not as super simple. So a point, the amount of points you pay is a percentage of the loan amount. So 1 point, 5,000. If it was 2 points, 10,000. So that's where the point piece comes in. Now, the key to start evaluating this is, okay, how much different does the rate change? So I'm going to throw out some random numbers, guys. These aren't necessarily specific rates today, but just to get an idea of how this math works for us. So let's say today a no points rate, often called a par rate, was at 7%, 7.0%. That could be one option for us. And let's say a client said, okay, hey, I want to pay a 1 point fee. Where does that get me? Well, that might bring us down to, say, 6.5%. So say in this example, 0.5% lower, and 2 points might bring us closer to 6.0%. Now, you will see in this case, I'm showing a 1% fee, roughly equaling a 0.5% rate. That is not always the case, guys. Again, like a stock, these are traded in the marketplace. So you will see some unusual spreads. Sometimes paying a 1 point fee will get us a 0.5% lower rate. That's great. Other times, paying a 1% fee may get us 0.125% rate. Well, that's a very small discount. And it comes down to the appetite in the marketplace. So a little bit goofy that it doesn't always make sense, but ultimately, if investors aren't buying the 7% coupon, the cost to do that is going to be higher. So that's why it's, again, not a crystal clear formula. I would say throughout my career, we typically saw a 1 point fee was closer to a 0.25% reduction rate. I would say at the moment, points are a little bit more favorable where they might be a little closer to 0.375 or 0.50. Now, again, each scenario is going to be specific, and it's even going to be specific on the loan product. Is this a VA or a conventional or FHA? So something we want to help evaluate. So going through it, kind of getting back to should we pay points or not? So just some real quick numbers. If we were saying 500,000 loan, scenario one, what may be the difference in a 0.5%? So if we'd said, okay, a difference between 6.0% and 5.5% may be roughly $160 a month. Now that's great, saying, hey, we're saving $160 a month if we were to buy that down. What I'd like to analyze for a client is, does this make sense or not? A couple of factors. The first is the break-even analysis. Hey, if we pay a $5,000 fee, 1 point, to save 160, how long does that take us to break even? So if we said 5,000 divided by 160 per month, that may equal about 31 months or so, I believe it is. 31, months. So on that for us, guys, it's thinking, okay, 31 months, about 2.5 years. Well, in a 30-year mortgage, that's obviously a pretty small portion. So, hey, if it takes me 2.5 years to break even and I have the remaining 27.5 years, that could offer huge savings. That was the original idea behind points. But here's the key piece is 2 questions. How long are we going to be in the home for? I know that's a tougher question to answer, but even more is how long am I going to be in this particular loan for? So, for example, if we think there's a chance we may sell or refinance before that 31-month break even, points may not make sense. If we were to refinance in 1 year, well, now we paid $5,000. We only saved 12 months worth of 160. We didn't get our $5,000 back. So I just like clients to really take that approach and say, hey, there are many, many cases where a little bit higher rate and lower points is still the better financial deal in the short run. So I think it's key that what is that break-even analysis? Because again, unfortunately, I've seen a lot of clients over the years pay tons of points, maybe not quite realizing that and thinking they got a great rate, their payments down. Well, it's going to take them years and years to recoup that. Now, if they truly keep the loan that long, awesome. But so many haven't. And oftentimes that's a lot of fee they've paid up front or built in their mortgage that they never reap the benefit on. So that's going to be key point number one is, what is the break even? Do I feel I will actually have this loan long enough, whether I don't refi or sell, to actually break even and make a benefit from those points? Number 2 is, hey, if we decide points make sense, you're definitely going to keep the loan long enough. Well, number 2 is to say this was a purchase. If that's extra cash you're bringing in to cover the points, does that financially make sense? In the sense of this, hey, it may be good long-term, but if I spend an extra $5,000 today, squeeze myself too tight and I'm uncomfortable, or that doesn't let me put towards another debt, it might not still be a good option for you guys. So I think I just really want to make it clear. Points can be great, but there's a lot of scenarios where they can't. So it's really going to be individualized on your particular cash flow, payment comfortability, what the break-even analysis is. Those are all key pieces for us to kind of look through for you guys to help advise on it. So with that, guys, when we're looking at the marketplace and you're out there looking for a mortgage, just keep in mind so much comes down to what is the total cost. Multiple lenders can give you a ton of different rate options. So if one lender says 5, one lender says 5.5 or 6, it doesn't necessarily mean that 5 is a better deal. So it's really going to be important. Now, to add one more small layer on this, guys, is points are one aspect of closing costs. When you look at a lender, there's going to be other things, potentially an origination fee, a processing fee, an underwriting fee, or a points fee. So a key piece is, again, as you're comparing just on a cost basis, maybe, hey, this lender, what's that total package? One lender may have less points for a rate, but they charge an origination. The next lender may not. So I don't mean to confuse you guys, but I want you to understand is a key piece is what is the rate and the total cost I'm getting. Let's not hyper focus on just one line item, because oftentimes they're adjusted around. It's still saying, what are the fees I'm paying for X rate? And I should evaluate a break-even analysis or compare up months lenders. Now, other than this, I know many other videos we've talked about, tons of other reasons to allocate or focus on different lenders, for other perks. But again, just in the finance basis, I want you guys to think through those things. So I hope that helped today, guys, to get a little bit of understanding of what points are, how they work, the huge range of options you have, and again, a few different ways you should evaluate if they make sense or not. And again, always, guys, that is what a loan officer is here for. We're happy to chat through the details for you to help you make the best scenario or choose for your particular scenario. Thanks so much, guys.